What's up, everyone? And today we're going to be talking about should you invest in Lyft's IPO. It's coming up, so that's what it's going to be about. Okay, thanks for joining us today. And if you didn't know, last week Lyft actually filed its prospectus, or an S1, basically saying that they would IPO in the upcoming months. And so I gave it a read through because I had a couple people ask me if they should invest in the IPO, and so we're just going to get straight into it. So Lyft is actually operating at a huge scale. Revenues are actually really big, $2 billion in revenue annually, and it's actually growing at nearly 100%. So it's come down a little bit in the past couple quarters, but the last quarter actually revenue came in at 94%. So that is incredibly fast at such a big scale. And of course, Lyft is going up against a huge competitor, none other than Uber, and the two of them are just going back and forth, just growing so quickly because essentially Uber created ride sharing, this category of the platform of connecting drivers and passengers, and it's really disrupting taxis, and you know the rest of the deal. However, Lyft kind of came in there because there's room for two players essentially. But one thing that I think investors should be kind of wary about is Lyft's take rate. So a take rate is, when you're a marketplace, how much of your revenue is taken from your users. So in this case, it would be the drivers. How much do you make off of, say, a driver drives somebody to the airport or something and makes $40? How much of that $40 do you take? That's called the take rate. And in marketplaces, there's a lot of science around what's the optimal take rate, but if it's essentially too high, then that leaves room for another player to come in and undercut it. So it's interesting that Lyft's take rate has really been ticking up over time, and that's something that investors will have to watch. Because if it's too much, then maybe Uber can come in and cut it a little bit. And that's one reason why I think Lyft was even able to enter the game in the first place, because Uber's take rate was too high. There was all those stories about Uber drivers not making enough just because they were just taking so much money from them. Another thing to think about is Lyft is very much mission driven. They have a lot of good innovation ideas. Scooters they were talking about a lot. One thing that I think is pretty innovative is something called Lyft Concierge, and basically companies, if they're trying to organize their employees to get places, they can use Lyft services as essentially a way to move their employees around. So another thing to think about is Lyft's losses. So the company actually lost more than 40% in its latest quarter, but that's actually an improvement from way larger than that actually as a percentage of revenue. So it's important to look at it as a percentage of revenue, because if it's getting better, that's a good thing. It's not necessarily about the absolute amount, because companies, especially growing this fast, are really trying to take market share. As long as the unit economics are positive of a business, it's okay if the company is losing money in the short term at least. So unit economics is an interesting thing. It's basically how much does it cost you to acquire a customer and how valuable is that customer for you. So if you're acquiring customers at a cost way higher than their ultimate value, then that's not a good thing. But essentially the idea is that for a short time, a company is losing money on a customer, but then there's a break-even point, and then from there on, that customer is profitable to the company. I think this company is interesting. I like that it's growing fast. I like the industry, but I think that take rate thing will be especially important because they're making all their money right now off of that increased take rate versus just growing organically. I think the ride-sharing space will obviously grow, but it'll be interesting to see how much Uber and Lyft actually attack each other. But ultimately, I think it's going to be difficult for both of them to really come out on top, because each of them is going to just be trying to take market share, because the company with the biggest market share has the biggest brand, therefore more customers will essentially flock to it, because then more drivers will have to be on that platform. So I think there's a lot of aspects here, and it really will come down to the valuation. If Lyft's valuation, because of all these factors, some investors are maybe wary of the situation. If it doesn't explode, then it possibly could be a good IPO, but that is very unlikely. So often with these high profile IPOs, everybody goes crazy, tries to jump on the bandwagon, and so it likely will be extremely overvalued as soon as it trades. And so that's something to think about. But generally, I'm thinking that if it's anywhere under 30 billion, it will probably be a really good investment. But it's very low likelihood that it will actually trade for a reasonable valuation. So those are just some things to think about. I would say stay on the sidelines because these high profile IPOs, I can just remember Snapchat a couple years ago. Just the company was so overhyped. It got all the way to like $30 per share. Now it's somewhere, I don't even know, under $15. And so just think about acting rationally versus just investing in it because you've maybe taken a lift one time. And so that's just something to think about. I hope that was helpful. Appreciate you. Hey there, really appreciate you joining us at Investing City. We have all sorts of resources for you to learn as much as you possibly can about the stock market. From going over how to analyze a stock, to actually analyzing a stock, to personal finance issues. And so we really just are so happy that you're here with us, and we hope you get a ton out of it. Have a good one.